Is the Toronto real estate market as bad as it gets, or will it get worse? Toronto real estate data just came out for November, and we wanted to share with you some insights. Do a quick wrap of what has happened since rate hikes in 2022, share things that have been changing more recently, and then how all of this positions us for 2024 in the world of Toronto real estate. If you're new here, I'm Samantha Chan from Elevate Realty, and our brokerage wants to help you make smarter real estate choices in Toronto. Don't forget to like and subscribe if you enjoy this content. Let's begin. Right now, the market is definitely slow in Toronto. Affordability is probably at its lowest level at probably peak Bank of Canada interest rates. Adding to that, the usual holiday slowdown might end up pushing prices even lower over the next few weeks over December and early January. As you probably know, there is a relationship between interest rates and real estate prices. As interest rates go up, prices come down, and as rates come down, prices have the potential to come back up. Now, what's interesting is that even though fixed rates have been coming down slowly, prices haven't adjusted up, but has actually come down a little bit more simply because there's just not enough activity these days. Check out the 3-year bond yields. They've fallen by nearly 90 basis points, wiping out most of the higher for longer sentiments that led to higher fixed rates since early summer, taking us back to what we originally expected since the Bank of Canada's bold rate moves in the summer of 2022. Now, how fixed rates work is that they are linked to bond yields, but the rate that it tracks it is a little bit different on its way up versus down. On its way up, they do track it pretty quickly and go up almost right away, but for obvious reasons, banks are incentivized to move rates down more slowly as they gradually track bond yields. Right now, the best 3-year fixed rates are at around 5.5%, but it does have the potential to come down more. And once these levels are hit by fixed rates, then we're probably looking at settling at prices that we have seen somewhere between July of 2022 and early June of 2023 before bond yields adjusted upwards more over the summer. Now, if we look back, the bond market did regain its confidence in the spring of this year, 2023, and so real estate prices hit pretty high levels at around $1.15 million on average between February and June of this year. On the flip side, when things were more uncertain earlier on with high and growing inflation back then and stronger GDP from July of 2022 to January of 2023 this year, the Toronto real estate average prices were much lower at around $1.07 million. Right now, we are slightly above that mark, but not that far off. And these days, the sales to new listings ratio does tell us that the current real estate market is at its weakest level since the 90s, but sellers haven't budged by more than what we have seen, and so prices haven't come down much since the major drops in 2022. So, based on all of this, here is the million-dollar question, or maybe even more since we're talking about Toronto real estate. Where are prices headed in 2024? In the short term, with the holiday slowdown, we wouldn't be surprised to see a bit more room for prices to fall over December and early January. But we do expect more activity in 2024, and then the next move in 2024 looks a lot more likely to be up than down as fixed rates continue to adjust, and then variable rates might end up following in mid-2024. Yes, we are very mindful that there is a potential for a recession in 2024, which would throw things off, and so we don't expect real estate prices to skyrocket next year. So what you can say is that we are cautiously optimistic for 2024, and what we will do is adjust our focus to more recession-resistant types of properties. So number one, we will choose residential over commercial for obvious reasons, as businesses and office spaces are likely to take a bigger hit compared to homes that people have to live in. Number two, we would choose more diverse economies like Toronto, which seem to be more resilient lately since jobs aren't as concentrated on a single sector. And number 3, lower priced homes will always see better demand. And so even if prices come down, they are more likely to recover more quickly. And next, on the rental side, we would opt for more affordable types of rental units. So think multifamily homes instead of luxury condos, or more bedrooms instead of less bedrooms. And to illustrate this, we'll walk through this example. The first option is a 2-bedroom unit in a triplex with 2 working tenants paying $2,800 per month in total. So that ends up being $1,400 per working professional. The second option would be a 1-bedroom condo with 1 working tenant paying $2,500 per month. So in this case, it would be lower risk to choose the 2-bedroom in the triplex over the 1-bedroom condo, and we would probably see less rent fluctuations and better vacancies here too. Wrapping all of this up, if you are navigating the Toronto real estate scene or you just want to prepare during the slower December holiday season before 2024 hits, we've got your back. We're not your typical real estate sales brokerage. Instead, we do focus on using numbers to make better real estate decisions in Toronto. And that can mean looking for stronger investments with positive cash flow, thinking about risk management, and looking for ways to boost returns like value add renovations and gentrifying areas. If you do want to discuss your private real estate situation with us, just go over to this link here to set a time to chat. You can also check out more content on our website or find us on social media. And if you haven't done so already, please like, subscribe, and share this video if you think someone else might like it too. Thanks so much for watching, and I'll see you in the next video. Bye.